stocks trade ranged amid growing uncertainties and volatile commodity prices. IT and energy are the green spots, while realty and FMCG flash red.
Bharti Hexacom floats a public offer for the government-owned TCIL to divest half its 30% stake in the Rajasthan and Northeast-based telecom operator for over 4,000 crores. Marquee anchor investors line up for the stock.
Ultratech Cement surpasses the 150 million ton capacity mark with over 5 million tons of new capacity going on stream. The cement major says it will invest over 32,000 crores over the next 3 years to further add capacity.
Stocks of Hindustan Zinc, Nalco and MOIL notch up gains after 3 report record-breaking performances in FY24.
Safe haven rush amid tensions in the Middle East boosts gold to a new high of around $2,280 per ounce. Buying by ETFs and global central banks sent short sellers running for cover.
Hello and welcome. You're watching us here on Halftime Report. I'm Manglam Malu. With me, Ekta Batra. All the 3 major indices mildly in the green. The mid-caps doing a lot better. The dip this morning was bought into, and that's a big positive, Ekta.
Hi, Manglam. Yes, absolutely. Well, today it seems as though largely we're consolidating in today's trading session. We have one particular worry which we need to keep our eye out on, which is Brent crude, which has risen up. So it's closer towards that $90 per barrel mark. So that is something that we need to continue monitoring in terms of commodity prices. But what we are seeing in today's trading session is that while the Nifty and the Sensex are consolidating, the mid-caps are marginally gaining and outperforming for the 3rd day in a row. And what stands out is that the advanced decline ratio is positive for the 3rd day in a row. It was around 8:1 on Monday. It was 4:1 yesterday. And today, it currently stands at around 2.5 to 3:1. So that continues to be positive. But nonetheless, we have a lot of cues to watch out for as well, Manglam. Today we have the ADP private payrolls data from the US. We have the US Fed chair speaking. We have, in fact, additionally 4 governors who will be talking in the US also. So we'll have a lot of cues overnight on the global front. And separately, we have the jobs data on Friday from the US markets. And alongside that, obviously before that will be the RBI monetary policy outcome, which we will be waiting for. It will be the first policy of FY25. So a lot of cues to watch out for.
A lot of cues indeed. So let's talk about a lot of the individual stocks then. Just keep an eye out on HDFC Bank though. The stock has moved to the high point of trade. It's had a decent week. It's up around 3.5%. But what's important about today's move is that it's actually crossed the 200-day moving average after today's up move. So the 200-day moving average of HDFC Bank was placed at around 1485 rupees. And now with the stock being at around that 1495 rupees, you would see that it's crossed that, and it's crossed that today itself. Staying above this and closing above this would be extremely crucial to watch out for. It's a technical factor. It's also the Nifty Bank weekly options expiry today, with the Nifty expiry playing out tomorrow. And we're in the first week of a new quarter, which implies that maybe we will soon hear from them on their 4th quarter update as well. But speaking about the cement space, Ultratech is the stock which is surging after the company has commissioned 2 new greenfield units. Nigel joins in with more on this.
Well, Ultratech Cement, they are stamping their authority. They're saying we are the boss of the cement industry. And in fact, we want to stay that way as well. Because a couple of years ago, when you had a new entrant that came in there, that was the Adani Group, people said that maybe it will not be so easy for them because they have enjoyed the dominant position. But they have stamped their authority and they've gone ahead and they have commissioned 2 more greenfield projects at Chhattisgarh as well as at Tamil Nadu. And in the last 12 months or so, they have increased the capacity by close to around 18 million tons. With this increase, they're now clocking close to around 151 million tons. And put into context in global terms, well, this capacity is close to 150% of what the United States has and 80% of what Europe has. To further put into context, well, they took close to around 36 years, the Aditya Birla Group, to add close to 100 million tons. And in the last 5 years, they've added another 50 million tons at a capex of close to around 30,000 crores odd. And they've outpaced the industry in terms of adding capacity because their capacity is up by close to 11 times in the last 2 decades. The industry is up by close to around 4 times. But keep in mind, they're not done. They're at around 151 million tons. They're adding close to around 35 million tons, which they've already announced. Add to that the Kesoram Industries acquisition, which we were on top of, and in fact we informed our viewers as well about that. So put all of that together, from 151 million tons, in the next 3 years or so, they'll be at around 198 million tons. And for this, they've committed a capex of 32,000 crores odd. So UltraTech Cement continues to stamp its authority in the cement space.
Okay, all right, Nigel. Well, yes, brokerages are also quite positive. The likes of Morgan Stanley is overweight and said that they are best positioned in the ongoing demand cycle. But Nigel, we're not done with you as yet. You're looking at a couple of these metal stocks, metal and mining stocks like Hindustan Zinc, Nalco, Moil. All of them are up and about.
Well, that's right. And they have momentum with it as well, because the metals PSU cycle actually has seen a lot of momentum in the last few days. Nalco, at the start of this week, we had told our viewers that that's the stock to track, because aluminium prices did bounce up and it crossed a couple of technical levels as well. So let's address the news first. Nalco overnight, well, they have gone ahead and they have said that they've delivered the best ever performance in FY24. And that's record-breaking as well. On the production side, on the aluminium, they have delivered the highest ever metal sale of around 4.7 lakh tons. That's optimum utilization levels. Even on the alumina side, they have delivered 2.1 million tons, which is 101% of their capacity utilization levels. But the kicker comes in because coal mining, the amount of coal they're getting from captive mines, that's moved up to around 2 million tons from the Utkal D coal block. Some part of the street was factoring a number of around 1.5 million tons. So that's what will result in further savings for them. Moving on to Moil, they've as well reported a record year, and they have delivered their best year all the way since FY 2008. So FY24 is one of the best years for them. Now, on the production side, they've delivered a growth of close to around 35%. And on the sales side, it's up by close to around 30%. Even a smaller part of their business, which is AMD, which goes into batteries, and it's dependent on imports, well, that one as well is up by close to around 28%. Finally, Hindustan Zinc. Out there, they have delivered a record number for the quarterly numbers. But in fact, the growth is still in low single digits. So 270,000 tons is what they have delivered. The refined zinc is up by close to around 9% on a sequential basis, 2% on a year-on-year basis. Lead as well on a sequential basis is up by close to around 5%. They're saying that in fact the volumes are driven by improved mix as well as higher ore production. But the kicker comes in because silver prices are up overnight and they have some exposure to silver. And for the past quarter, they've delivered a number of 189 tons. And for the year, it's close to around 745 tons. So the only silver play here in India, and that could be the reason why the stock is up. In addition to that, the limited float in the market of only around 2.5% is the free float on the stock. Back to you.
Ajahn, thanks a lot for that. In the mid-cap end of things, even as the mid-cap index is up around 1%, and it's up around 0.5%, big moves coming in on names like GNFC, Escorts Kubota, L&T Tech Services, Petronet LNG. And in that, there is an underperformer today, which is Z, which opened in the green, but now has moved into the red after the management announced some cost-cut measures. Vamakshi joins in with more details on that and the reason for that. Vamakshi.
Well, yes, Mangalam, Z Entertainment in focus today. After the Z-Sony merger fallout, we did see that the management had taken several initiatives for cost rationalization. The latest one being that MD and CEO, Mr. Puneet Goyanka, has taken a voluntary 20% pay cut. Now, let's also understand what this means in terms of numbers. In FY23, he took home nearly 35 crores as remuneration. So, a 20% cut would actually imply a nearly 7 crore savings, which is not as significant in the overall company's context. Now, the company earlier on has also decided to prune its technology and innovation center by almost 50% to achieve a cost-effective structure. Keep in mind that last year they had incurred an expenditure of almost 600 crores, and in fact the management in the past had also reiterated that they will be focusing more on return on investment, specifically with regards to TIC. Overall, these measures are in line with a much larger project that they've undertaken. They've institutionalized a structured monthly management mentorship, that is the 3M program, and the objective of this program is to achieve key performance metrics, which includes the targeted 20% EBITDA margin. Now, earlier on, we were also joined by Karan Torani of Elara Capital, who said that cost rationalization measures that the company has announced is in line with what they had guided for earlier. There is intent to improve the profitability for the company, but the stock will only see a re-rating only if the execution is done right. The upside is also restricted mainly on account of several legal overhangs on this counter. Their linear TV business is not growing more than 3 to 4%. They are quite dominant out here. But the digital business, on the other hand, has very good potential, but Zee has very limited exposure. Only 10% of their revenue comes from the digital business. Overall, when we look at the consensus ratings on Bloomberg as well, nearly 68%, a majority of analysts have a sell rating on this counter, 22% have a hold rating, while only 10% or 9 to 10% have a buy rating on Zee Entertainment.
Okay, all right, Vamakshi, thanks very much for that. So that's on Zee Entertainment. That stock is under pressure, has gained a little bit today, but nonetheless, that stock has lost over 40%, I think, on a year-to-date basis. We'll take a short break, but here's an important notice for our viewers. Please be cautious of fake accounts on social media platforms. Our anchors do not endorse or recommend any stocks. Exercise caution with direct messages from unfamiliar accounts. Follow us only on our verified accounts and catch all CNBC TV18 news and updates on Facebook, X, Threads, Instagram and JioCinema. Welcome back. Well, it's been a buoyant year when it comes to the IPO market in FY24, and FY25 has kicked off in terms of the primary market with a big IPO. Let's focus on that now. Telecom service provider Bharti Hexacom's IPO will open for subscription today. The issue is an offer for sale where the government entity TCIL will sell a part of its stake in the company. Rima joins in with more details on this.
Thanks so much for that. So Bharti Hexacom, the first IPO of FY25 and also the first IPO from the Bharti Group in over a decade. The last one was Bharti Infratel, which is now known as Industars, way back in 2012. So there is considerable excitement. But let's get to the IPO details then. The IPO opens from the 3rd to the 5th of April. The price band has been set at 542 to 570, giving it an implied market capitalization of 28,500 crore at the upper end. Now, this is a pure offer for sale, which means no money will go into the company. Now, who's the selling entity? The selling entity is the Government of India, an entity called TCIL, Telecom Consultants India Limited, which will sell half of their holding. They have 15 crore share. They're planning to sell 7.5 crore share and overall raise about 4,200 crore rupees. Now, Bharti Airtel is the promoter. They have a 70% stake in the company, but they're not planning to sell any stake. Now, about this company. Now, this is your telecom service, telecom company. It provides mobile services, but unlike, say, a Bharti Airtel, Jio, Vodafone Idea, which are pan-India players, Bharti Hexacom operates only in 2 circles in India, Rajasthan and Northeast. Now, in Northeast, the company is a market leader with a market share of more than about 50%, while in Rajasthan, it's the second biggest player with a market share of about 40% as of December of 2023. The company was originally incorporated way back in 1995 as Hexacom India. Then in 2004, its name was changed to Bharti Hexacom Limited, which is when Airtel had acquired a majority stake in the company. Now, this company pays a management fee to Bharti Airtel for common marketing, admin, personnel expenses, and this is approximately about 1.7% of its revenues as of the latest numbers. Now, on to the financials. The company's top line has grown at a CAGR of 12.65%. So revenues now, as of the last year, stand at 6,580 crore. But the big positive has been the margin improvement. And look at the margin trajectory. Margins in FY21 were sub 25%, and they've risen to nearly 50% as of 9 months FY24. And the margins of the company have basically doubled. Yet, the bottom line of the company has been fairly volatile on account of exceptional items. The big driver of the margin increase was a price hike, which took place about 2.5 years ago, which led to the ARPU of the company, ARPU's average revenue per user, rising from 135 in FY21, 155 in FY22, and now it's nearly touching the 200 rupee mark as of 9 months of FY24. Now, it's a fairly big IPO, but what one needs to remember is that it operates only in 2 circles. So the customer base has not been growing at a very fast clip. Growth for the company is coming from upgrading its existing 2G subscribers to 4G and price hikes. Valuations then, now FY23 EPS of the company was about 11 rupees, which means at the upper end, we're getting a trailing PE of 52 times. So it's cheaper than Bharti Airtel, which on a trailing basis is at about 80 times plus. But remember, Bharti is much, much bigger in size. Bharti Hexacon's top line is about 6,500 crore. For Bharti Airtel, it's 1.4 lakh crore rupees. Back to you.
Rima, thanks a lot for that. Take a short break, come back. On the other side, we will focus on the markets because now they're picking pace. The Nifty is closing towards that 22,500 mark and it's led higher by the Nifty Bank itself, which is about 47,600. At the high point, take a short break. Pritesh Mehta joins in to give us a sense of some trading strategies. Welcome back. You're watching us here on a halftime report. The markets picked some pace up, closing in towards that 22,500 mark for the Nifty. The Nifty Bank around that 47,600 mark as well. The range for the Nifty seems to be defined for the last couple of days. If you look at today's low, that's a telling one. It's 22,346 and the all-time high of 22,530. So the broad range of 22,350 to 22,550 is the one in which the frontline index is playing. But there are a lot of factors which can either make or break the range from here as well. The one is the Nifty Bank. We're looking at the Nifty Bank, its options expiry today. And the active options today are the 47,500 call, which is most active, and the 47,400 put. And there are a lot on Wednesdays who write both a call and a put at the same strike price, which is the 47,500 straddle, which has a premium of 140 rupees. So option writers are playing for that range of 47,350 at the lower end to 47,650 at the higher end. The Nifty Bank is around that 47,600 mark. So if it crosses past that 47,650 mark considerably, all those straddle writers will cover their short positions, and as a result of which we can see a further up move there, and that would be an important one to watch out for. For the Nifty itself, the other trigger is how the IT stocks perform. They've been doing well today. They've been supporting the index. TCS, Infosys, Wipro, TechM, all of them are gaining. And a lot of fresh long positions are added on a lot of these mid-cap or rather non-index IT companies like Persistent Systems and L&T Tech as well. Now, we spoke about how Hindustan Copper may enter F&O ban yesterday, and it did. The two stocks on my radar which may enter F&O ban today, one from the metals pack is SAIL, and the other one is Z, because typically Z has spent most of its futures and options series in ban itself for the last 8 or 9 series. And now, day 3 of the series, stock likely to go back into F&O ban.
Okay, all right, Manglam. Thanks very much for that. Pritesh Mehta joins in to discuss the technicals of the market this afternoon. Now, Pritesh, hi, welcome to the show. Well, it's turning out to be a day of consolidation. Mid-caps doing better. How would you approach today?
I think the set is clear. Or rather than focusing on the index, I think we need to focus on the broader markets, because when we look at the seasonality, the month of April tends to be well for the broader indices. Look at mid cap, small caps, and they have been through a lot in the month of March. So I think keep the index aside. It is going to do its own thing. Few stocks will keep the index higher, but the focus should be on the mid caps.
Okay, focus should be on the mid caps, but specific stocks, what's your strategy?
So there are several stocks. When we look at the chemical space, it is doing well. Apart from that, when I look at the pharma stocks, they are doing well. So let me go back to the pharma stocks. One stock which has been doing well lately, that is the Laurus Lab. This stock has been moving higher, but now it has given a break on the upside from a bullish turtle pattern. So we can see a move towards, a move of at least a move towards 490 levels from here on. The stock would be around 405. And apart from that, one particular stock from the PSC basket has come back. I'm talking about PSC index at Concor. So this stock, has corrected. Now it is finding a base. Now it is resuming the uptrend. So I won't be surprised the stock goes through the levels of 1,100 from here on, and the stock would be around 860.
All right, 860. Pritesh, would you have a view on a couple of these names? I was looking at Coal India, which had come on the charts for the last few days, now holding around that 445 mark. And the other one that I'm looking at is Persistent Systems. That too has moved well.
Yes, now see, there is an interesting case taking place in the mid-cap IT space. We have created a customized mid-cap IT index, and it has reversed from the peak of 2021. So yes, it is reversal coming in, but I won't be getting carried away. I think there's a small opportunity of reversal trade in all these mid-caps names, whether it's Persistent, Birla Software, and LTTS, also even LTIM. But I won't be keen to participate for the long run because I would be rather shifting my attention towards the large cap IT names rather than mid cap names. And so I think that is a space which is going to do well for at least like 3 to 4 months.
Okay. All right, Pritesh, we're going to let you go on that note. Thanks very much for joining in and speaking with us and giving us all of those strategies on the technicals. As we slip into a break, we have an announcement to share with you. We are launching CNBC TV18's first ever live personal finance webinar, CNBC TV18 Accelerate Personal Finance Handbook with Sonia Shenoy, where she will be joined by 3 well-known experts on Saturday, 11th May, 9 a.m. onwards. We'll be diving into everything you need to know to master your finances and learn how to grow your wealth, be it insurance, tax saving, managing your portfolio, retirement planning. There's a lot to learn and lots to do. Whether you're in your 20s, 30s or even 40s, this live webinar is for you. We have limited seats, so don't miss this chance. Register now, scan the QR code to register or log on to cnbc-tv18.com and we will see you on the 11th of May.
Well, a couple of these pharmaceutical stocks have suddenly begun to gain some traction. Lotus Labs, for instance, is up 5%. Most of the gains coming by in just the last 15 minutes or so. Strides Pharma, as the bottom of our screen is suggesting as well, has seen a big move. And again, it's a recent phenomenon that we've seen in Strides Pharma as well, the up move that has taken place in just the last 5 minutes or so. Let's talk about this space itself, the pharma sector. Multinational pharmaceutical companies in India are changing tactics. They're signing distribution deals with Indian pharmaceutical majors to market their drugs while they focus on launching novel drugs. Ekta is here to decode this new trend. Ekta, interesting one that.
Well, yes. I'll start with Sanofi, which is a long-standing player in India since 1956. In a swift and bold move, they made 3 distribution deals with Indian pharma companies within just 2 weeks. These deals involved Emcure, Cipla and Dr. Reddy's, granting them marketing and distribution rights for Sanofi's cardiac, CNS and vaccine brands respectively. This trend isn't exclusive to Sanofi. Other multinational pharma companies are also restructuring their operations in India. Novatis, for instance, is reviewing its majority ownership in its Indian unit. This follows multiple deals struck in the past 2 to 3 years, which aimed at optimizing its portfolio. These included granting distribution rights to Dr. Reddy's, a licensing agreement with Cipla, and selling brands to JB Chemicals. Such moves aim to cut costs, as seen with Novartis reducing its workforce by 400 employees, Sanofi's employees working on cardiac brands given a choice to join Emcure, Eli Lilly letting go of 120 employees when a deal was struck with Cipla, and companies such as AstraZeneca considering selling their Bangalore site and looking for a buyer who can also work as a contract manufacturing organization for the company. MNCs face tough competition from Indian firms, which often have better reach and scalability. An example is Dr. Reddy's, which has 3x Novartis's field force and 10x the physician connections. MNC heads admit they cannot compete the way Indian pharma companies can, and a distribution tie-up still allows the MNCs to own the brands, generate sales, but with lower overheads. The marketing prowess that Indian companies have is also the reason why many MNCs are partnering with Indian companies to market even their new products. Examples include Glenmark's collaboration with Pfizer and Mankind's deal with AstraZeneca recently. Due to intense competition and limited pricing power in generics, MNCs are focusing on launching new drugs and boosting R&D. Novartis plans to expand R&D operations through its unlisted entity, even if it sells its India unit, while Pfizer sees India as a key market for expanding its product range. AstraZeneca too has indicated their strategy in India continues to be focusing on launching novel drugs and therapies. Lastly, for Indian companies, these distribution partnerships help strengthen specific therapy categories. Cipla, for instance, is focusing on its diabetes portfolio, while Dr. Reddy's is now the second largest player in vaccines. A tie-up also sets up a relationship with the MNC for a future tie-up with the company, exposure to the parent pipeline's innovative drugs.
Interesting one there, Ekta. Pharma MNC's change in strategy, outsourcing the distribution and marketing to domestic players while focusing on creating novelty products. To discuss this further, we have two experts for you. Salil Kalyarpur, who's the former Executive Vice President at GSK Pharma, and Vishal Manchanda, who's the Pharma Analyst at Systematics, joining as well. Salil, let me come across to you first. From at the outset, it looks like a win-win situation where companies focus on their strengths and outsource their distribution, which in India is not their strength. And the Indian distributing companies also get an additional kicker coming in from these tie-ups that they do with MNCs. But the question is, where do you think is the catch? I mean, is it, why is this strategy suddenly becoming famous, and is there any downside to it?
Well, I think I agree that it's a win. I don't know if it's a win-win, because it's definitely a win for the Indian players, because they're getting access to great brands, they're getting access to products that have some equity in the market, and they are using their strength of marketing and distribution muscle that they have, which is far higher than what MNCs have, and so therefore it's definitely a win for them. For MNCs, the win comes in terms of fixed margin deals, or that which brings money into their coffers without having to do much. However, if this was compared to the kind of growth that MNCs could have had in a market which is like India, the size of the market, the growth of the market, and all of that, I think MNCs could have done better if they were on their own, if they had actually developed strategies that were more market-oriented rather than trying to do what their parent company does everywhere. So I think there's a little bit of an issue in the way that this is going forward. But I also think that if you take the future portfolio, the research portfolio that MNCs are trying to bring in, which is what we are told is the strategy, there are issues that MNCs will face. There are headwinds that they will have in terms of patent laws being not in favor of evergreening and all those kind of things. The kind of pricing at which new medicines are launched in India, which is not India specific or India friendly at all. And so therefore, even with the number of patent products that exist in the market, we haven't really seen the market expanding or multinationals actually growing their foothold in this country. So even if you bring in R&D and innovative products into India, with the current situation, it doesn't seem like MNCs are in a good place to kind of compete in this market.
Okay. Well, Vishal, coming to you with regards to what is taking place, do you think that there would be many more such kind of deals which are probably going to take place? And who do you think benefits more? Is it the MNC because they have lower overheads, better marketing prowess, or the Indian company which probably gets a foothold into a therapy they otherwise lack some kind of presence in?
I think the agenda here for the MNC Pharma to out-license their brands to Indian companies is primarily they don't want to increase their employee strength in India selling branded generics, because even if they do that, build more employees and are able to sell a larger volume of their branded generic portfolio, it actually doesn't make a large difference to the parent company profits. And that's where the mandate flows from, basically. So, and so they have actually never invested in scaling up the branded generic business in the past. They've always been focused around the brands that parent companies have provided to them, and they've been selling that. But now probably they've reached a juncture where scaling up these brands has become difficult with with their employee strength not growing. And we can also look at the IPM currently. The volume growth in IPM is getting a bit slower than it used to be in the past. So there are challenges that MNC pharmas are facing. they are not able to kind of actually, with the branded generic portfolio, they're not even able to meet the inflationary expenses. So the employee inflation, etc., are not kind of met by the growth in the branded generic portfolio. So they've chosen to outsource this to Indian companies and basically cut their manpower so that they can continue to operate profitably here. So
Okay.
I think more of the Indian companies will get to benefit, but not a great benefit for Indian companies on their side of the business.
Okay. Well, Celine, just coming back to one specific example, Novatis, what do you think their strategy is in India? Because, they're looking at that strategic review of their listed entity. Do you think that they'll probably exit that listed entity entirely? And what is the rationale of operating through your unlisted entity?
So I can't say if Novartis will exit or not. The review obviously is something that is likely to happen because I think it has in some way probably something to do with the way that they looked at their generic business globally through the Sandoz demerger or delisting. But from an Indian perspective, it makes a lot of sense to kind of get out of that market and then try and bring in their global products through their 100% subsidiary, Novartis Healthcare, and try to, because those kind of products are not something that requires high number of field forces or a greater number of distribution or something. Those are very niche or small segments of doctors and patients who Novartis will cater to. Having said that, I think that is probably something that they're trying to do. They will, like Vishal said, not try to get into the branded generics. It makes no sense to them, and so therefore they've handed it out to Dr. Reddy's, and they're planning to exit that. However, this is not good news for Indian shareholders because when dividends get paid out, they don't get paid out when products or profit is made through the 100% subsidiary, and so therefore there might be a little bit of unrest that might kind of come up over there, and so it could probably be not as smooth as just exiting from their India listed entity.
That's an interesting insight out there, Salil. Just wanted to know, with this strategy from the MNCs, does it in any way impact the innovative abilities of or the R&D abilities of the Indian companies itself, where, they will start to focus on these deals instead of innovating themselves?
I think so, because, from a R&D perspective, there's not much to report on from an Indian perspective, from an Indian company standpoint. And so while there have been certain products that, at least there was a certain amount of motivation with which Indian companies had approached this about 10 years ago. We saw that, Dr. Reddy's, Glenmark, and some of the other ones like Zydus and all, which were investing a lot of money, started to kind of slow down on that. There were a lot of scale back on R&D, like the Piramal group did. And so, from that perspective. But I think it makes a good amount of sense for Indian companies to try and think about deals with multinationals, because that is one way in which they could get world-class medicines into India and then kind of, grow access for that through India-specific pricing or through a strategy that Indian companies can execute better on, rather than on multinational companies actually fighting with parent companies on the pricing pressure, because reference pricing becomes a major issue for multinationals when they have to launch at India-specific pricing. And so many MNCs are unable to do that in India. And so from having a strategic partner in Indian organizations, maybe 3 or 4 of them, it kind of adds a lot of weight to the kind of brands that can be built. So there have been examples of how companies like Merck and Novartis actually built large brands or much larger brands through collaboration and co-marketing with Indian companies for patented products. And so it doesn't kind of reflect well on the MNC capability to market even patented products, but it's just about how they are looking at accessing the market in a stronger way and kind of bringing in more revenue in a market where they are not capable of doing it themselves.
Okay, Vishal, from a stock point of view, how would you approach the MNC stocks? We've spoken ad nauseum about Indian pharma, but MNC stocks, anything that you like, what would it be from an investor standpoint?
Have actually been kind of kept on moving higher for MNC companies. So if you look at AstraZeneca, GSK Pharma, Abbott, these if you look at the last 5 years, these stocks have done extremely well. Probably, so these are kind of opportunities where you can generate consistent cash flows, maybe grow around 7-8%, get 3-4% dividend every year. So I think at current prices, these are all about 11-12% opportunities, 11%. So basically, low double-digit compounding opportunities, but not multi-baggers. I would say these are kind of safe bets wherein you can get maybe low double-digit returns kind of opportunity.
All right, Vishal, Salil, thank you so much for joining in and giving us this insight on what is an interesting strategy which is being now deployed by all the MNC pharmaceutical companies. Ekta, from a consumer standpoint, I wonder how this would be big if an FMCG major, an international FMCG company in India did not build its own distribution and outsourced it to some Indian players. It's non-intuitive because some of the best distribution in India has been built by these MNCs like Hindustan Unilever and Nestle.
So GSK is a different, is a different entity. They have an extremely strong distribution system. But over a period of time, the pharma companies, the Indian pharma companies have increased their prowess so much when it comes to marketing and distribution that the Indian MNCs, most of the Indian pharma MNCs just can't catch up. And hence it makes more sense to collaborate as compared to build their own distribution marketing strategies. So that's what's interesting. What happens to us as consumers? We get more access to the medicines because now they'll be distributed better across the country.
Why compete when you can collaborate? That's the key takeaway from this. With that, we'll slip into a short break. And as we do that, here's something that you must not miss out on. It's a CNBC-TV18 exclusive. It presents India Exchange, where both market experts and industry stalwarts will collaborate in an insightful discussion on India's economic path and evolving dynamics of the Indian market itself. We'll be mapping the macros across India with City India economist Samiran Chakrabarti. There will also be a jugalbandi between market veterans, and this is something that I'm excited for. It's Manish Chokhani, Ramdev Agarwal, and then we'll talk about the return of the animal spirits within India Inc. It's a conversation, an exciting one with V. Vaidyanathan of IDFC First Bank, KK Mistry and Manish Kejriwal of Kedara Capital as well. And then for those who are looking to chase alpha, there's a discussion with market experts like Nilesh Shah of Kotak, there's Prashant Khemka of White Oak, and Anish Tawakle of ICICI Pru MF. Don't miss out on this. You know what to do. Tune in to CNBC TV18 on April 4th. That is tomorrow evening, 5:30 p.m. onwards.
Hello and welcome to REIT Connect, our special offering on understanding real estate investment trusts as an asset class which can be part of your diversified portfolio. Now, very recently, SEBI chairperson said that there is big potential ahead for business trusts like REITs and InvITs. Let's find out more about SEBI's views on the growth potential for REITs. I'm joined by today a special guest, Pramod Rao, who's the Executive Director at SEBI, right here in our studios. Mr. Rao, so good to have you on CNBC TV18.
Thank you.
Now, my first question, what is SEBI's vision on business trusts as investment category, both REITs as well as InvITs?
I think I will put it in 2 or 3 buckets. Indeed, I think it's a great opportunity for sponsors and developers to monetize the revenue-generating assets they have created on the ground. There's an opportunity for investors to partake in that, and as those assets perform, they can have exposure to that. And I think the way I would equally put it is that when these assets are monetized, the virtuous cycle of further capital goods creation, sort of gets fueled. And indeed, you mentioned Chairperson's, sort of outline. I would echo that. I think there is a full potential of this actually equaling our GDP. If we get it right across corporates, municipal corporations, and indeed the government sector as well, harnessing these innovative financial instruments.
Right. So it has the potential. But what are the measures? See, it came a long way. These business trusts, Mr. Rao, we have been seeing it for more than a decade in the inception stage, and then a lot of tax-related efficiencies were brought in to make it more attractive. So several policy decisions were taken to make it attractive and a viable asset class for investments, for investors to make returns. Now, what is SEBI doing as 2.0 steps to make them much more robust and to enhance the liquidity and for investors to get attracted more to these products?
I think I will again sort of go into two elements which are there. One, while you mentioned it's been 10 years in the making, we should not sort of underplay what has been achieved. It's nearly now 4 lakh crores in asset under management of both REITs and InvITs combined. That's a huge number. I think we should sort of just acknowledge that itself. I think what it can and what further measures, I would say last year, for instance, we took the step of empowering investors at a certain holding level, or if they come together, to have representation on the investment manager. To us, that was sort of, again, bolstering the position for both investors and long-term investors to have a seat at the table and be able to interact and know what the InvIT and REITs are sort of planning and doing. I think beyond that, equally what I would say is we are very encouraged because a lot of foreign investors are coming into this segment, largely sovereign wealth funds, but overseas pension funds. So I'm hoping that the Indian pension funds and insurance companies also take cues, because this is a natural sort of long-term asset for them also to be in part of.
Yes.
So I think these are what one is hoping start to take roots. Retail in an organic way has already reached a good high number. And I think it's without the benefit of, the association, for instance, of REITs, which we've encouraged creation of,
yes,
as also InvITs. And I think when they start to equally make, events like this, which are investor education and investor outreach, I think there'll be a far more traction.
Right. So you spoke about retail. Let's focus on different categories of investors. Now, retail is something SEBI closely watches out for, and for the protection of the minority investors. Now, for retail traction to increase, and this particular product is unique in a way that it has a assured dividend every 3 months, which is not there in other unit equity kind of products. So it is unique in a way. How would you say the retail participants can really gain momentum, and what is SEBI's view on the participation going forward?
So, one, I don't think it's assured return. I think it is indeed return from what the asset is generating. So I just want to put that out there. I don't want investors to think that this is a short return product. It will vary with, how the asset is performing, for sure. But it's a real asset, whether it's real estate or whether it's an infrastructure asset. I think that's the direct participation that investors get. I think to me, there are 2 or 3 sort of things which I'm hoping evolve and get in further retail non-institutional investor participation. I think one would be very clearly if we can see mutual fund schemes which are targeted at this segment. At times when I've spoken with them, what they've said is there are too few to sort of immediately launch a scheme and do things. But I think if it is a mix of both REITs and InvITs, there should be something possible. So I'm hoping that there are thematic, or there are, or even for that matter, index, which is created on REITs and InvITs. NSE launched one such index last year.
Yes.
So again, there's opportunity for, mutual funds to sort of look at that. I think that again brings both investor confidence that there are institutional investors willing to look at it from the domestic side as much. I think that will go a long way.
Right. So the traction in mutual funds need to increase. So a lot of them do share that there are a few changes and tweaks. If they are made, then their traction could really increase. But we spoke about institutional investors. Now, non-institutional investors, especially foreign investors, they like clarity as well as simplification. Do you think anything is on the anvil for further simplification or for attracting them more towards business trusts?
So I think all of the building blocks are in place. So that would be transparency, that these are well governed, that there are due disclosures, And much more than, I would say, other pooled investment vehicles. If I had to look at AIFs or mutual funds, the unit holders are consulted on a host of issues.
Right.
So they have approval rights on at varying scales, some majority, some at 60%, some at 75%. I think all of this has meant that there is a high degree of confidence the investors that we've interacted with, many of them institutional, many of them from overseas. I think the next level, if at all, like I said, has to come with retailization. And I think retailization comes when it's not a REIT or a InvIT which is promoting the instrument or the product, but an association doing it. There's a neutrality to it. There is the explaining of these instruments, the business trusts and units, which I think has now got started with the Indian REITs Association, I think, coming together. And I'm hoping that is what investor education leads to far more retail participation.
Right. So we have seen at the behest of SEBI in the past, AMFI was also created. And look at their stupendous journey right now and the kind of inflows that they attract.
Exactly.
So you think that that can be achieved through the efforts that are being taken in REITs and InvITs as well?
Yeah, I mean, that's the example we hold up to the Indian REITs Association and to Bharat InvIT Association, which is AMFI has, and both their campaign in terms of mutual funds sahi hai. Yes. I keep telling them, you have to say REITs right hai, things like that. Right. And I think those are the measures which will propel it to a different level altogether. And that's why I hark to that, it is 4 lakh crores so quietly, so efficiently,
yes,
without, any of this. And if you imagine now that you will have a far more educated outreach to retail, I think it'll really grow even more stupendously.
REITs, from the beginning, like, it is a much newer product and it is now coming up with its different versions and small ticket versions as well. But great chatting with you, Pramod Rao. Thank you so much for all your insights on the development of the new asset classes like REITs and InvITs. Thank you so much for joining us right here.
Thank you for having me, Nisha.
Welcome back, and joining us on the show now is Ashish Pethe. He's owner at Vamanhari Pethe Jewellers. Ashish, hi, thank you so much for joining us. And it has been one big bull run that we've seen in bullion to begin with. 2280 almost done, and the June futures in COMEX are trading at $2,308 an ounce. So clearly 70,000 is just a matter of time right now. But I do want to understand on how is industry dealing with this very volatile and one-sided strength times.
Good afternoon. I must tell you the industry has been taken a little by surprise by the speed of this rally. Everyone was expecting gold to reach 69,000 in the domestic market. But the speed at which it has gone has surprised many. At the retail level also, the retail customer is a little surprised. So he's taking the wait and watch road. But I think the consumers are now clear that the bull run of gold is here to stay. It's for the long term. So they are not, averse of this price rise. In a way, they are happy that the price is going up because everyone has some form or the other of gold in their households. So the retail customer is happy. Jewelers are, being cautious about stocking up for the future festivals that are coming, like Padwa or Akshaya Tritiya. And the large jewelers are now again focusing on the hedging part of the gold because it's an uncharted territory, all-time highs all across. So to manage the inventory is going to be tricky. So that's what's happening in all three sectors of the industry.
Oh, I get that. The way the gold has moved up, and as you said, going forward, there are a couple of things to watch out for. So whether it's about Akshaya Tritiya or even Gudi Padwa for that matter. Feb wasn't so great. March has been a complete washout. And the way April has begun with these all-time highs, yet again, as a jewelry industry, what kind of numbers are you working with in sense of prices now? How are you doing your calculations?
I think the industry has understood that 65 is the next, bottom that we can look at. Earlier, we were looking at 58 or 60,000 as the next bottom, but now the gold has taken out 65 so convincingly, and it has stayed above 69 for a couple of days. So I think 65, 66 is the next support that we can look at. At the retail level, I must tell you, I'm surprised at the consumers, outlook towards gold, because they have slowly started coming back. The walk-ins are happening, and even at 69 at the retail level, the rates would be around 70,000. People are buying, and it is not a complete washout. Obviously, yes, we're looking at 20-30% drop, but yes, consumers are still coming, and once the prices stabilize, then they will come in and buy whatever they are looking at.
Ashish, you said 25 to 30% of total sales are happening, or 25 to 30% of a decline in sale is happening?
Drop in terms of volume, but the price rise is, buffering that a little. Yeah.
Ashish, also, what is the kind of sales that the street is now anticipating going forward for the month of April and May right now? Is it going to be about lightweight jewelry? Do you think more investment is coming in? And I also want to understand on what is the exchange here. Are people buying all fresh jewelry, or do you think the exchange composition has gone up?
No, as I've always said, that the exchange goes up when the prices go up. That is a given. People are looking at lightweight jewelry. In some markets, people, even retailers are, making 18-karat jewelry in the traditional designs. And people are testing those waters in lower caratage in traditional jewelry. But one interesting fact that we have seen that whenever there has been a spike from, say, 40,000 to 50,000 or 50 to 55, people have rushed in to sell their old gold. But last two rallies from 60 to 65, now 65 to 70, that rushing in to sell is not seen at the retail counters. People are not coming to sell because I think they have realized that the prices are going to head northwards. So no one is selling, and they're sitting tight. That's a unique thing that I've seen in this rally particularly.
All right. And I'm sure that's good as well, because yes, people have made money, because if you bought gold last year at same time, 56,000 was the price. Today is 70,000. So it has been a very clear-cut buying on that gold that people must have done last year. Ashish, as always, thank you so much for joining us and making sense of what really is happening with the gold rally and how various stakeholders are looking at it. But with that, it's a wrap on Halftime Report. Business Lunch will take all the action ahead.